Okay. Good afternoon, everybody. I would like to present a paper co-authored with Aleksander and Mercik entitled Transmission Dynamics in Crypto Markets, Comparing Volatility. We are trying to compare volatility and liquidity spillover networks. So the outline would be quite a regular one. I should acknowledge the financing authorities, and so what's the study about? The background is that we observe the rapidly evolving cryptocurrency market, where we have both very dynamic changes in returns. This means in volatility and in volumes, which in our paper relates to liquidity. So we are trying here to explore connectedness and volatility and liquidity based on 54 most capitalized cryptocurrencies over 2018-2024. So these are those 54 most capitalized which are listed through all this period of the whole period, and we focus on the transmission between cryptocurrencies, both transmission in volatility and in liquidity. What are the similarities or differences in those transmission paths? And we're trying to identify the so-called central nodes in networks, and also describe the dynamic performance of those transmissions. So I will skip this. I assume everybody is aware of how fast-growing segment of financial market the cryptocurrency market is, but it raises the question about the dependent structure and the risk spillovers. And what we are focusing here on is the most important from the point of view of investors, which is the volatility and liquidity. And we are trying to apply here the network approach to allow to describe this multivariate dependencies. We rely here on the very common notion recently, the contagion or spillover or connectedness, due to the methodology which was introduced quite recently. This is quite popular in academic papers, so much popular that it's perhaps the best time to move to the next step, but it's still it relates to this one. We try to identify the leading or the driving cryptocurrencies, or those which are the source of liquidity or source of volatility changes, so we utilize the frequency connectedness and the variance decomposition as at the approach of Diebold and Yilmaz and the later authors based on that. It allows us to assess the systematic risk and this evolution via the network-wide connections. So over the time from 2018 and 2021, we've got several peaks and declines in the market. We can thus observe the dynamic changes in volatility and liquidity as well. We utilize here both the static approach, so-called static approach, which is the average over the whole period, and the dynamic analysis in the moving window. So what is the contribution to the existing literature? We have here this dual risk dimension. We are looking into both volatility and liquidity, and the joint effect of those two, I mean the joint interactions between those two. We are identifying those central players in the market. We are checking how much the market capitalization matters, and if it matters. And we are utilizing the quite long period for that. I will skip the literature review, as there is quite a lot of papers which relates both to spillovers or connectedness and to cryptocurrencies. But if we are talking about cryptocurrencies, it's usually about the volatility itself or volatility and returns. And so far we haven't found the papers which will connect those two spaces, like volatility and liquidity. So the source of the data is from CoinMarketCap. We've got those 54 cryptocurrencies, which has the complete data We apply the usual filtering, as the data are not always very clean ones. How we calculate volatility, we utilize here the Garman proxy as Garman class as proxy or estimator, which based on open, high, low, and close prices. And for liquidity, we are using Amihut's measure, which is wind sensorite at 99% here for this case. We are checking the stationarity of the series and all the usual stuff, just to see how the cryptocurrencies in our sample behave over time from 2018 to 2020, at end of 2024. You can have the picture. So we've got some peaks, we've got some declines here. If we're looking into the correlations between volatility and liquidities, here we've got the matrices for all 54. So you can simply, within this heat map, you can simply recognize that the correlation between liquidity is much higher than for volatility. We are using a bit different methodology here. I mean, not basing on the correlation itself, but based on the vector autoregressive models from which we take the covariance, error covariance metrics, and based on that, we are able to calculate the connectedness measures, so-called total connectedness index and directional spillover indices to, from, and net, and this net is the difference between to and from. So within this connectedness measure approach, we are able to find out the, let's say, what are the overall changes in the contagion within volatility and liquidity. We are using for the visualization, we are using the networks just to show what are the kind of dependencies between just to visualize this connectedness measures for both volatility and liquidity of those 54 cryptocurrencies. And we are also applying some kind of ranking to indicate which are the strongest drivers or the strongest players in particular category. So the total connectedness index, which is based on this connectedness measure approach, for volatility is 96%, for liquidity is 90%, so it's a bit higher for volatility. And within, just to make the plot of that, to see those 54 cryptocurrencies and the volatility and liquidity, we'll make it on the networks. Within a particular plotting convention, I will say a word about that because it will be a bit difficult to understand what's on the plot later on. So we've got the color of the node, which is red if this is, if a particular cryptocurrency is more sending than receiving. Blue if this is more receiving than sending. The node size will be related to market capitalization. The edge width is related to the strength of transmission. And we are using here the Fruchterman-Reingold layout, which makes the most central nodes in the network inside. So as I said before, the red ones are those which are more sending than receiving, and blue ones are those which are receiving more than sending. The size is related to the market cap. So what we can see here is that, first of all, volatility and liquidity networks are quite similar in the kind of, let's say, the dependencies inside. In liquidity, we have a little bit more dense network. Not all the edges are presented here as we utilize the approach in which it can be visualized in a better way. So we just focus on the most important edges, most important connections. What is here perhaps visible is that receivers which are, I mean, those nodes which are receivers in volatility are also receivers in liquidity and vice versa, and that bigger cryptos, those for which the nodes have higher sizes, bigger sizes, are more connected. So usually receivers are outside, and those which are transmitters of volatility or liquidity are inside. So they are more dense, more related one to another. And just to give you the point where we've got the Bitcoin here, similar will be on the volatility one. Ethereum is here, and for instance, Dash is in the middle of the graph. Based on the ranking for, the TOPSIS measure for which allows us to obtain one combined value for the ranking of the centrality of those nodes. We here we've got the ranking for volatility. The last column is for this TOPSIS, so this let's say kind of index for all of them. So you can see what are from the top, what are the most important in terms of volatility, what are the most important nodes, and the same in case of liquidity. We also have the list starting in this case from Ethereum. In both lists, you don't see as the first 10, there is no Bitcoin on them. So, but in general, the nodes, so the cryptocurrencies which appear in the first 10 for volatility and liquidity are often the same. So the next step is to move toward the dynamic connectedness. So that's here we are looking into total connectedness index for liquidity and volatility, and we compare those two. You've got this on the graph over time, starting from the June 2018, and the red one is for volatility, and the blue one is for liquidity. So we can see that this index is always higher for volatility, but the dynamics, the moments in which transmission of the information from volatility within the system in volatility and liquidity, the timing is more or less the same. So we've got we observe similar behavior of those two indices. And here I will have few figures on these particular dynamic spillovers indices. I will perhaps skip the last one. So this is the net for volatility, where we compare the dynamic spillover indices for particular cryptocurrencies. And the gray area is all the range of values which we could obtain over the time. And here we've got the big ones and the smallest ones, the first three biggest in our sample and first three smallest in our sample. And it might appear that top cryptocurrencies tend to send more volatility to the market than they receive, and vice versa, the small ones tend to receive more than they send. So in that sense, it means that size matters. The same story for liquidity. Again, we take three top cryptocurrencies in terms of market cap versus three smallest one, and perhaps here in this case, this discrepancy, this difference is not that well visualized. That's why what we do is we utilize the whole sample and divide it into four quantiles, where Q1 will be for the smallest cryptocurrencies and Q4 will be for the largest one. And we apply the Mann-Whitney test to compare the distribution of those indices. And I will again focus on the net index. So for medians of indices, in case of both volatility and liquidity, are always different one from another. The distributions are different. So at the p-value, which is 0. So it means that in fact, the biggest and the smallest cryptocurrencies behave differently in terms of sending and transmitting the information. And here we've got the comparison of those medians. The red one is for volatility, the blue one is for liquidity. So you can see that those medians are even not overlapping over the time. The last point is to provide the grander causality test between those total connectedness indices between volatility and liquidity, and what we see here that volatility is a grander cause to liquidity, and both liquidity is a grander cause for volatility. Being more specific, we can look into the VRR model, a part of the estimation here where the volatility in leg 1 seems to have an impact on liquidity and on volatility itself. So I'm talking now about this one, and based on the first line here, we can tell that this impact of volatility, volatility has more impact on liquidity than liquidity on volatility itself. Okay, so the findings are that the grander causality test allows us to identify significant predictive linkage between total connectedness indices and volatility and liquidity, with the stronger impact of volatility on liquidity than liquidity on volatility. So it seems that volatility is the first power which pushes the market, and liquidity is more, let's say, following that. So the conclusions are like, we've got some distinct patterns in liquidity and volatility networks. We can see that they seem to be quite similar, with the liquidity network being a little bit more dense. We observe the dynamic spillovers, which are consistently weaker for liquidity than for volatility, even so they are quite high. And both those spillovers intensify during turbulent periods, which is let's say also confirmed in the literature. And what we also put here, that the market capitalization or the volume which is traded has a rule here. So there is a stronger transmission from higher capitalization, high cap cryptos to smaller ones, and this let's say transmission is decreasing over time. However, it's not. We couldn't find the proper let's say test for that. So and the implications, we will have the high volatility appears to be more contagious than the lack of liquidity, and this will be important, as we believe, for the risk management, investor portfolio managers, and regulators. And that's it from my side. I will be happy to answer any question, and thank you for your attention.
Do you look at any other liquidity measures other than amplitude?
Not in this case, mainly due to the fact that we do not have more data than the volume in this case.
Sure.
But would you?
This is doing the F paper, and they compare these different low-frequency proxies like amyloid to high-frequency proxies, like the polar spread, effective spreads, and they basically show that one of the things they show is that amyloid is essentially uncorrelated with liquidity. But things you could do is measures like Poznan Schultz, Ronaldo, even the roll measure. I think all of these should work with the data that we have, because you need high-low, close, volume stuff. So that should work.
Yeah.
Conceptually, of course, it's difficult to use these measures if you have aggregated data like from CoinMarketCap. But even just using trading volume seems to be a better proxy for liquidity, as in quoted spreads, effective spreads, than amyloid.
Just trading volume, you mean? Like logs for logs
I
of.
don't know if they use logs or not, it's probably different, but they just compare them and show the correlations.
This is a good.
A lot of that is doable even with your data.
We wanted to skip Corvin-Schultz because this is applying the high-low again, and some other studies showed that you are not sure if you are proxying liquidity or volatility. So it's
sure, but they are always going to be correlated, right? I mean,
yeah,
so
that's true.
It's always going to be difficult to disentangle them.
Okay.
I agree. I mean, Corvin-Schultz tries to take volatility out of it. That's but yeah, we can take this.
Okay. Yeah. Thanks. Thanks a lot. And our comments. If not, thank you for your attention, and we have got lunch time now, so enjoy. Thanks a lot.